raised too much? Too little? How would you know? What are the right terms in the market today? Is the South the best place to raise your capital? Or would you be better served going to the coasts? Chances are, if you've looked into this kind of information, you've consulted the work of Peter Walker, head of insights at Carta, Valor's fund administrator. Our team and I were super stoked that Peter came in from San Francisco to share his insights with our team and our LPs at VC Day. Super relevant stuff. It turns out that 25% of Carta's data is actually from our region, from the South. I know you're going to really enjoy his insights. It is our January Atlanta Startup Podcast feature. So without further ado, here's Peter.
As Lisa mentioned, my name is Peter. I run the insights team at Carta. I won't bore you with what Carta does or who we are. We can get to that at the end. But I'm going to run through a ton of data about what we know about what's going on in venture capital this year, with some specific focus on the South, and then, of course, Q&A at the end. But I'll say up front, as I start with a compelling set of texts from our lawyers, which I am legally required to do, even though they're not here. First off, yes, if you find this interesting, you can certainly get this deck. Please just email me after the talk. Happy to share it with you, and then you can share it with whoever you so choose. And a little bit about where this data comes from. So right now, we aggregate and anonymize data from about 45,000 US cap tables that are currently active on Carta. So that's anywhere between 50 to 60% of all US startups manage their cap table through Carta. This is data from priced equity rounds, the traditional venture rounds you're all familiar with, as well as safes and convertible notes, which are a little bit harder to find on places like PitchBook and CB Insights. We have over 100,000 individual signed safes in the last 4 years. And the fund data, which is the sort of latter half of this presentation, comes from about 3,000 venture funds that manage their back office, their fund admin through Carta as well. So a whole host of data. 24% of those companies, by the way, are in the South. This is a view on the market. It is not the view on the market. So I'm sure some of you will disagree with some of these numbers. I'm happy to hear it. Shout that disagreement loudly. I'd love for this to be a conversation rather than a lecture, but there will be time for questions at the end. Okay. So that was boring. What can I do with this data? Let's start with some fun stuff. This is data from Q1 through Q3 of this year. Sorry, there's a typo in the headline there. And it's just the median pre-money valuation of seed stage startups across the country, with some select southern cities, and then, of course, the Bay Area, Silicon Valley, as that blue bar. You can see a couple things stand out to me from this chart. One, as expected, the valuation medians kind of drift downward from Silicon Valley to other places across the country. But maybe even more impactful, the bars, which is the 25th to 75th percentile, are super wide. No matter where you are, those bars, those distributions are very, very wide. And this is for two reasons. One, these naming conventions, seed, Series A, contain a whole multitude of stuff within them, right? They are basically just terms we use because we got to call them something, but they don't tell us all that much about what's going on in the underneath financial profile or trajectory of these companies. And the second thing is, of course, that great ideas are not restricted to Silicon Valley. So you can have wonderful outcomes both on the bottom and top of these ends. And it's true that if you say raise a round at the 50th percentile for your seed, that is in no way a guarantee that you will remain there for your A or beyond. Companies jump from percentiles to percentiles depending on the trajectory of their business. You can say same thing for cash raise. So in the Bay right now, the median seed round is raising $5 million. Not true so much in DC, Miami, or Atlanta, but again, you can see that the bars are very, very wide here. So taking a step back from some Southern data, giving you some context on what venture has been going through over the last couple of years. So necessary context. Yeah, this is awesome. 2021 is the boom times. Oh no, that sucks. Or I would posit, does it suck? Really? $70 billion or so invested in a single quarter is completely unsustainable. So it felt great. It was wonderful to be a part of it. Carta certainly benefited from that boom time, but hey, we're dealing with the hangover and have been dealing with that hangover for the last couple of years. And if you look at recent quarters, you see about $20 billion invested into Carta companies per quarter. That compares very favorably to 2019 and the beginning of 2020, right? If you just removed 2021, maybe we're a little bit below where we want to be, but it's nothing like the sort of doom and gloom that we expect because we always compare ourselves to the peak. So when I'm talking to founders, I say, look, if you have friends who raised in 2021, don't talk to them. All right? Their experience is not your experience. You can say friends, but like just text, not live talking. Nowhere has escaped this downturn, but the closer you were to IPO, the harder this has been for you. So actually fundraising is the hardest at the late stage, that most sensitive to interest rates, most likely to take on an impact from the closure of the IPO market, whereas seed and Series A, far enough away that there's still a little bit of optimism there. How many of you are founders? Okay. How many of you are investors? Okay. I got to skip like half my talk. I just badmouth investors usually. Okay, I'll try to do my best here to make this good. No. For the founders in the room, what does all this fundraising data mean for you? Well, first and foremost, private companies are staying private a lot longer than they used to. I think this is one of the under-discussed radical changes that have happened to venture over the last 10 years, is that the difference between a company on median IPOing after 8 years and after 13 years is a gigantic gap. And we're much more towards the latter end of that range. So median Series D companies on Carta are already 8, nearly 9 years old this year. So you have to plan for this to take a decade or more. And when you get down to the rounds, that has an obvious impact for founders. So the old wisdom, quote unquote, from Sand Hill Road is you're going to raise every 18 months to 2 years, 18 to 24 months. That used to be pretty true. You can see the blue section there. A lot of companies were actually raising every 18 to 24 months. Not so much these days. You can see these lines drifting up, Series A to Series B in particular, showing some real problems there. So if you're a founder right now and you're raising a round and you're planning for that round to only last you 18 months, you are planning to fail. Do not do that. Make your plans as though this is going to be the last cash you raise for 2.5, even 3 years. Because there's nothing fun about a bridge round. And there's nothing fun about shutting down either. That's not great. So what are VCs doing if they're not investing into new companies? A lot of them are spending time and attention on their current portfolios. So bridge rounds are at record rates right now, bridges, extensions, whatever you want to call them. These happen for 2 reasons. 1, a company's doing really well, or 2, the company's doing really bad or bad enough, right? There are preemptive bridge rounds where the VC is so excited about their portfolio company, they'd like to preempt the A and get more equity in there. But most bridges are because that company needs a little bit more cash and isn't able to bring in new investors. And what we've heard from a lot of VCs is it's okay when I'm being asked to bridge a few of my portfolio companies, but over the last 2 years, I've been asked to bridge the majority of my portfolio companies. And at that point, you have to choose among your children, and that's hard. So what happens if you can't raise a bridge? You may end up raising a down round. So 20% of all the rounds on Carta this year have been down rounds. That's 2 times higher than historical averages. I was kind of thinking that we'd be through this by now, but doesn't seem like it. I'd expect that down round percentage to stay elevated for the next 6 to 9 months at least. Okay, pre-seed and price rounds. How many of you invest on safes? How many of you like safes? No hands. Wow. Okay, great. Well, that's tough because safes are sort of eating this early part of the startup market. Basically, everywhere we look on Carta, safes are the dominant vehicle for raising pre-seed cash. They've replaced convertible notes outside of some narrow industries like biotech and hardware. But for your standard SaaS company, the safe is being used basically everywhere. Those safes come with all sorts of terms. The 2 that really matter are valuation caps and discounts. Basically, every safe that we see on Carta has a val cap of some kind. About 30% or so, maybe a little higher, have a discount as well. And then uncapped, undiscounted safes those are from your parents. Those aren't real investors aren't giving you those. And what kind of safes are they? There's two real types here, pre and post money. When on this chart do you think YC changed the default from pre to post money on their website? If you guessed right here, you're right. Right. So this is a great chart that I think shows the power of defaults across startups. YC simply took pre-money out of their website entirely, and everyone was like, great, we'll just use post-money from now on. No real thought about it, to be honest. Why did they do that? Post-money is more favorable to the investor. So I think it's probably a good thing on net that we're using post-money because it's a lot more clear, but it does favor the investor over the founder. We can get into why if you want. Other stuff that are happening with safes. Some investors, many of you probably, look at a safe and go, I don't love it because it doesn't give me enough certainty and it doesn't give me enough rights. So what many are doing is adding their side letters. MFN, information rights, and pro rata in a side letter gives them a little bit more certainty, the kind of stuff they would have wanted to see from a price round, but they can do it on a safe. If you're a founder, I think these are reasonable terms to agree to. Maybe this is one that you have some distinctions on, whether or not they're leading, et cetera. But in general, you should expect you're going to sign side letters with your safes a lot of the time these days. Valuation caps. So like, what are these companies being quote unquote valued at? You can see that the valuation cap, which is just focus on the black line for a second, goes up as you raise more money. Obvious, right? When I talk to founders, that's not so obvious. It doesn't seem to get through that the valuation cap is not a valuation on your business. And it certainly isn't a reflection of your character, which also seems to happen when I talk to founders, right? You are not a $7 million founder when you have a safe that has a $7 million valuation cap. That is simply the outcome of the math equation. How much are you raising for how much of your company? So again, if we use the YC example, every single YC company raises on a safe. What is the valuation cap that they raise on? Does anyone know? 2 million. Pretty close, 1.78. The reason they don't talk about it, other than 1.78 being weird, is because they say, we take 7% of your business for $500,000. The Shark Tank model. If you're a founder in this room, that is how you should be thinking about your safes as well. Ignore the val cap. It doesn't matter. What matters is how much dilution are you taking on? Is this 500K check worth 10% of your business? Is it worth 15% of your business? Is it worth 5% of your business? No right answer. Just a question of safes are not free. They come with dilution. And that is what you should be focused on, not I'm a $7 million val cap founder. When we see people raising on safes, they're doing quite a lot of funky stuff. They may be raising on 2 or 3 different safe rounds. It's not amazing, but most of the time, by the time they're raising real significant cash, $2 to $3 million, they start looking more like a regular venture company raising on price rounds. So what are those valuations? We'll get into how the South stacks up specifically to these general numbers, but this is kind of a shocking chart to me. That black line is median pre-money valuation for a seed stage company on Carta. It's better, it's higher than it's ever been. The peak was literally last quarter. That seems really weird, right? We're supposed to be in a venture downturn. So what's happening? The gray bars are the number of rounds. The black is the median pre-money. The orange is for a bridge round, so we can ignore that. Nearly 900 companies raising this quarter, only 470 raising that quarter. So the bottom quarter or so of the distribution, those deals just are not happening anymore. So the median naturally rises. The other thing is that for really competitive, yes, oftentimes AI rounds, those deals are hotter than they've ever been. It feels like 2021. So inside of this venture downturn, we have an AI bubble. And that screws up a lot of these metrics. A la this. So I cut the AI line off here when ChatGPT really kicked in. So this is seed stage non-AI, and this is seed stage AI. Massive premiums being devoted to AI companies. But you can see that non-AI companies are still raising, and they're still raising for pretty decent terms, honestly. Same kind of pattern at Series A, 45 million pre-money valuation. You had $10 million in cash. It's about $50 million. It's a very expensive company for a Series A company. And here you can see maybe even more of an impact. Non-AI companies sort of struggling to break out of the malaise. AI companies at a significant premium right now. A lot of that is happening in Silicon Valley, and a lot of that will end up being wasted. But it's venture, so a lot of it's wasted anyways, right? It's all good. So again, if you just plot these metrics against each other, valuation back up over where it was in Q1 21, number of rounds way lower. Valuation close to where it was in 2021, number of rounds 50% less. So if you just look at the median value, you're not getting the full story. A lot of it's about the activity, the pace, the actual fundraising activity happening. And if you compare that, this is a little bit janky, but south to west, you can see that a bunch of these patterns remain true. The West has higher seed valuations and the rounds haven't fallen quite as much. I think this one at Series A is interesting. So Series A valuations for the South are about 10 to 15% higher than they were 2 years ago, but 61% fewer rounds happening. So that, if you're a founder, is what you're feeling. You're like, well, I see these deals. I read about them in TechCrunch, whatever. It seems like people are raising crazy amounts of money. But when I talk to all of my founder friends, we are all struggling to raise. That's the dynamic that's happening right now. Lots and lots of companies out fundraising. Maybe not right now because they know it's not a great time, but January 1, those inboxes will be flooded. So what does that mean? There's just all these companies out in the market. How should we expect them to translate from round to round? So this is an idea of graduation rates. This is how many companies get from seed to Series A. And the quarter is the time where they raise their seed round. So, a year in, only 5% of these companies have raised their Series A so far. 2 years in, you can see there was a boom time where it was pretty, a lot of companies, 4 out of 10 of them had done it in less than 2 years. And now those graduation rates have fallen off quite a lot. So if you're a founder listening to this, what you should expect is that you are competing with a lot more companies than perhaps you would have used to. And there are younger companies coming up behind you who didn't have to deal with all the craziness of the interest rate changes and the pivoting your company and the layoffs and everything, right? They started in AI assumptions, high interest rates will move fast. And that's tough. You risk getting swamped by younger companies. Always a risk in venture, almost certainly happening more often nowadays. Another illustration of the same dynamic we've been talking about, number of rounds much lower, but the high end, those 95th percentile valuations, the stuff that gets the TechCrunch articles, those are as high as they've ever been. There's a lot of capital sloshing around in venture waiting for a great deal. And when people get consensus on the fact that they've found one, the competition for those deals is really, really high. So it pushes all this stuff up, but probably not great to compare yourself to those people. All right, so we talked about how these companies are being valued. How are investors doing? What are investors actually taking from these companies or settling for when they raise these rounds? About 20% in a seed round and 20% in an A round. This is the one sort of standard wisdom around venture that our data completely bears out. But you can see if you have to raise a bridge after that, you're again selling quite a bit of your company. If you do a Series A and then you have to do a Series A2 preferred whatever, it's about another 9% of your company. So in total in Series A, you sold 29% of your business. It's a lot. That dilution adds up really fast. And of course, dilution isn't the only thing that you're looking at. You're also looking at the deal terms. So high liquidation preference, participating preferred, et cetera, et cetera. It's cool to see that really these aren't very common in seed and Series A. Still, most of the deals that we're seeing are clean, not introducing a lot of complexity on the cap table. But if you're later stage, you're talking, you better have a good lawyer because those deals are coming with bunches of strings attached. Which founders are trying to raise literally right now? I'm so sorry. Tough month to raise. It seems like it's a great month, right? But these are the highest percentages of the whole year. A lot of terms are signed. A lot of term sheets are signed this month. not a lot of them start their negotiations this month. So your investors are kind of wrapping up the deals that are already in the hopper. And then you can see in January and February, things really slow down because new deals are starting to be negotiated and the actual signatures come back in March. So if you're a founder that's, cold outreaching some VCs right now, maybe save those emails, save those shots on goal until January 1. Maybe not January 1 as well, because you'll hit a lot of spam. All right, so that's what's going on for startups. Let's talk a little bit about what's going on for funds, because obviously what happens to those companies needs to inevitably be reflected in some of these fund metrics as well. So we took a look at 1,800 venture funds on the platform from vintages 2017 to 2022. And this is just the committed capital for each of those funds. We think that this is the biggest ever study of funds $100 million or less, those two bars, in history. Most venture capital studies, when you read them from Cambridge or Preqin or PitchBook, et cetera, they are focused on big funds, right? 500 million, $1 billion plus, et cetera, because that's where they can get the information from their LPs. That's much harder to get from smaller emerging manager funds. We have a great density of that. First thing that venture funds did when this downturn happened was stop making new investments as quickly. So deployment pace for more recent vintages is below the deployment pace of the earlier ones. That makes sense, right? Probably all you pulled back, evaluated whether or not the deals you were doing or the deals you wanted to do, et cetera. So then how does that impact your performance of these funds? If you're judging a fund, vintage 2022 here in 2024, those numbers don't really mean very much, right? It's been 2 years. They're not mature enough to have any sort of real impact. There could be great funds that are quote unquote doing poorly and really bad funds that are doing really well. But up in 2017, 5-6 years ago, those numbers are starting to be more meaningful. So what is a great fund performance at this stage? We see 21% is the 75th percentile IRR. The median is 13, 14, and the 90th percentile is 31. There are funds that are much higher than that, 50, 60% IRR after 5 or 6 years. So this is kind of a bad chart, right? Comparing all these against one another doesn't make sense because there hasn't been enough time. So we can just plot them as J curves and see 2021, pretty significant J curve, struggling to get back up to 0. 2022, same thing. And these earlier years benefited from the boom times and have slowly come back down over time. Of course, everyone, when we put these charts out on Twitter, is like, well, look at the S&P. We could have just invested in the S&P. I hope that's not the takeaway here, and more sophisticated LPs would know why. But that is funny when people say that. By the way, we do expect that these J curves were a little bit softer. They're zeros right now because they weren't on the general ledger at that point, but they weren't quite as severe as this. And then the fun one, DPI, actual cash back. What this chart shows is the percentage of funds in a given vintage year that have any DPI at all over time. So 3 years in, 9% of 2021 funds have any DPI, which if you're expecting DPI from a 3-year-old fund, you're in the wrong business, right? Do not expect that. But you can see that for earlier vintages, it was quite a lot higher. Same thing here, on down the line. So the biggest question in venture is, will those funds in more recent vintages catch up? Or have they been sort of permanently on pause? My instinct is yes, they will catch up, but we haven't had any IPOs and we haven't had any exits and it's been really hard. So hopefully 2025 is better. Let's talk about how. This is one analysis that Lisa asked that we do, which I found very interesting. It looks at what percentage of LP capital to these funds came from the same state as the fund itself. So the higher the percentage, the more local the capital is. And you can see the green funds, or the green states are in the south and the other just kind of some smattering of where we had enough density to do this analysis. I don't know if there's any pattern here that really makes sense to me. I was expecting this state to be higher, but it looks like actually LPs are willing to cross state lines pretty regularly. Not enough, though, of course. Are there a lot of LPs in the room? Can't be investors. Okay, fine. Fine. All right, so let's talk about exits. First thing you got to look at when you're talking about exits is the one that don't make it. So these is an exit of a sort. Shutdowns have been rising. Obviously, there were a lot of companies started and funded in here. And if they're not going to materially graduate at higher rates, then 2 or 3 years later, you're going to see a lot of shutdowns. And that's what we're seeing now. 2024 will be the worst year for startup shutdowns ever on Carta. 2025, I think the first half will be worse. And then it'll start getting better. But nobody's idea of a fun time. That's correct. Although I don't know if you'd be investing in these ones. Yeah. IPOs. Where did they go? This, we do not. Chamath heard you talking about SPACs and he shut down the presentation. So this is Coatue data, but they do not include SPACs in this. So, we did okay in the boom times of pushing companies that were doing well into the public markets, but since 2022, there's been basically nothing. Now, there is a lot of optimism about next year that you read in every banking report, they've actually never predicted a down year so far, and they're right half the time. But we are starting to see some good signs in real data. So this is number of acquired companies by quarter. 170 acquisitions in Q3. We think Q4 will be higher. And you can see that compares very favorably to the highest point in 2022. Of course, the next question, are these good acquisitions, right? Are they high quality acquisitions? Are people making real money? Or are these fire sales, acqui-hires, et cetera? We don't know exactly, but we can see the percentage of acquisitions that are happening by stage. Seed and Series A are the most acquisitive times, but the percentage of that is declining a little bit. So there are some later stage companies that are starting to get bought as well. Some of those are definitely going to be quality acquisitions. I won't comment at all about recent election changes and whether or not that'll have an impact here, but everybody else says yes, it will. The hidden side of liquidity. There's 3 ways to get liquidity, really: IPO, M&A, secondaries. We've all read about the big secondaries that have happened at OpenAI and Stripe and other places. We are also seeing that at Carta. These are tender offers, so company-sponsored secondary events where they get a group of early investors and employees together and say, hey, we've got some outside investors who want in. Would you like to sell your stuff or a portion of it? Trickling back up, about over $1 billion transacted last quarter. We think Q4 will be better than that, and we think Q1 will be better than that. So I do think that secondary markets are heating up to a really large degree. The downside of this is, if you think about it, why are companies like Stripe and Databricks and other people doing really, really big secondaries late stage? To my mind, it's because they don't want to go public. And if you think about that, that's a problem for everybody else. There's really no reason for a Stripe to go public at all. They have unlimited access to private late-stage capital. They can use secondary transactions to get liquidity for their employees, and going public just adds a regulatory burden on them. That doesn't apply to most private companies, right? We're talking about SpaceX, Stripe, maybe a couple other names. But if you want IPOs to really kick off, you want one of those big names to go. That would be like the starting gun for this race. And whenever people are talking about 2025 as this huge year of IPOs, I want to temper that optimism by saying, I don't think any of those super late stage big companies are going to go out, because there's no reason. They don't need to. We are hearing whispers that might change regulatory wise over the next 5 years. But again, if you know John and Patrick at Stripe, give them a text from me and say, hey, consider it for the rest of us. Okay, the fun stuff, how the South stacks up. So positive trends for us on the Carta side in terms of share of rounds happening in the South, getting pretty close to the Northeast here, maybe a little bit down this year, but the long-term trend I think is pretty positive for the South to eclipse the Northeast as the second biggest region for venture pretty soon. Obviously that's on a regional basis, not specific cities. Pretty cool. If you look at the share of M&A versus the Northeast, for instance, just crossed over this past quarter. So venture companies can be built in the South. Venture companies can be exited in the South. I think our data proves that pretty conclusively. We went through a couple of how these valuations stack up. Again, there is a premium being applied to Bay Area and New York City companies. Whether or not that premium reflects anything about the underlying business or simply supply and demand, and that it's a more competitive market there, I think is up for debate. But those numbers are still pretty decent in the South, for real. Series A, you can get, again, a bit more distinctions here, but to me, the size of these bars is more important than the centers. There are great deals happening everywhere, and they're happening at all sorts of terms. So comparison is often the thief of joy if you're a founder. Same thing here. That's an expensive Series A round, raising $13 million. As a median in the Bay, more like 7 or 8 in the South. This is everyone's favorite punching bag on Twitter, so I thought I'd look into it. How many of you are on Twitter, by the way? Healthy. Wow. This is the most healthy, well-adjusted crowd I've ever spoken to. I am on Twitter and I am not healthy. So when this is debated, because Keith Raboy keeps bringing it up annoyingly, the question is Miami a good startup city? Are they going to replace Silicon Valley? And the answer is, of course, no. But yeah, kind of, right? And it depends on what you're talking about. There is no late stage capital in Miami because the companies are not big enough to justify late stage investment. So if you just look at it as a percentage of total venture capital, you will always get a tiny, tiny percentage, and you can put it on Twitter and say Miami sucks. Or you can do the data rigorous thing and look at it by stage and say, actually, Miami in safes is 6th in the nation, 8th in price seed rounds, 9th in Series A. If you had looked at that 5 years ago, they would have been in the 20s. There has been a change in these ecosystems. So when you're judging places like Miami, Charlotte, Raleigh, up and coming ecosystems, it doesn't do them any favors to judge them against venture capital as a whole. You have to start small because that's where the capital will begin. And that's where those companies, if they choose to stay there, will then grow into the local champions that you're looking for. End here with a little bit of data from the compensation side. So we manage the equity for 1.3 million employees in private startups. So we can look at what they're being paid and compare it to places across the country. We have salary data for about 900,000 of those employees. So we can say, hey, what was the percentage of the San Francisco rate, which is always the top market, for all of these cities in the South? So if you are a tech worker at a private company in Miami, your salary is probably 12% lower on average than the salary in San Francisco. Of course, this is just salary figures and doesn't take into account cost of living. So if you take into account rent and cost of living, et cetera, there are many cities here who actually give more purchasing power to those tech employees than SF itself. And many of those cities are in the South. I think something like 12 of the top 20 cities in terms of purchasing power are actually Southern cities here. So great point for you to use when you're hiring your next employee.